I'm Lou Spellman, financial market economist. Today is October 20th, 2019, and basically we are at a very interesting, important juncture in economic and financial history, actually. It's that large an issue. What we're having is a major change in the framework of economic policy. Economic policy that we've been living under since World War II is basically the end of World War II agreements to keep exchange rates constant, which is something called the Bretton Woods agreements. And then after World War II, the Keynesian ideas of monetary and fiscal policy emerged, and they're now at their fruition of the forefront of economic policy of virtually every country in the world. But we're having major changes going on in that framework. I've lived it my entire adult life. I've taught it. I've worked for the governmental entities that laid it out and set it forth. But things are changing, major changes. And here's what the change is we have now something which was a background issue for a long time coming back to the forefront. In addition to monetary policy and fiscal policy as means to try to manipulate an economy into positive growth and positive impacts on financial asset market pricing, we're back to some old policy issues that were really tackled first about 200 years ago. The first of which was the thought of having exchange rate stability. If you don't have exchange rate stability, if you don't impose upon countries exchange rate stability, very easily they can literally print their own currency and go to the exchange rate market, sell their currency, cheapen to the rest of the world their currency, so that foreigners can exchange their currency into the now cheapened currency and buy goods with the cheaper currency. Basically, it shifts trade to the country that's expanding, and it can be done so easily. All one has to, and in the world of 2019, who is doing it? Reportedly, China is doing it. It's so easy, and it's you almost can't even monitor. Difficult to monitor. It basically, as I say, if an economy is floundering, other than going to the bond market, sell bonds in the name of the government, and spend a lot of money to get the economy riled up and revved up, and basically all you really need to do if you want to have an exchange rate manipulation is have the central bank literally print the currency, the home currency, and sell it on the foreign exchange market, causing the price to go down so foreigners can buy your currency and hence your goods at a lower price. Hence, we would then run a trade surplus. So we would benefit from the buying of our goods by making it cheaper for foreigners by the manipulation of the exchange rate. Easy as can be covered up. So it goes back at least 200 years where countries try to get into agreements that no one would do this. And we've gone through various eras of that. The most important semi-modern was the Bretton Woods agreements coming out of World War II, which was now probably about 75 years behind us. It happened in 1945. So that's about 75 years. So basically, that was the background. Bretton Woods was supposed to put a kibosh on that. In fact, what was the number one agreement coming out? And I think there are 45 post-World War II countries that signed the agreement that they would not manipulate exchange rates. And it might have taken some monitoring on the others, and I'm not sure what the enforcement was. There was some mild enforcement. But that went away. Now that went away in that we de facto are having countries manipulate their exchange rates. That's an old one, actually, that's coming back. The concern of countries manipulating the currency is happening again. The second one, another background policy issue, not an issue, but it's more or less a rule, is capital outflow restrictions. Countries in general aside from fiscal and monetary policy, would run policies where they didn't care to have their savings accumulated to finance development in another country, which is quite understandable. And particularly these days, it has to do with less developed countries or slower growing countries, or countries that are having capital flight because of political reasons. But capital outflow restrictions used to be and still largely is there, and if it's not there, it can get put back in place very quickly, is if capital flees, if, in other words, savers want to invest their money elsewhere, well, the savings, which depletes the spending in an economy, and it ends up getting used to finance spending in another economy, basically was seen as objectionable, particularly by countries that were less developed countries. So those old issues are coming back: exchange rate stabilization and capital outflow restrictions. Now, what's going on in the world today? We have a world in which several major countries like Japan and the European zone are stagnating. So if we use today's policy tools of fiscal and monetary policy, particularly monetary policy, that says that the central banks of those countries print money and buy bonds to get the bond price up and the yield down, so the interest carry cost of new investment in those countries is lower. Hence the idea being the hope that there'll be private investment spending that takes place as a result. So since these countries, i.e. Europe and Japan, have been very sluggish in responding to what already is cheap money in those countries, has caused their central banks to go back to the well and keep printing the money and keep buying, in this case, government bonds. Bond prices up, yields down. They got the yields down. They have yield rate targets. They got their yields down to very low, then to zero, and then the unthinkable, used to be the unthinkable, never been there before, prior to the last, say, half dozen years, they got the rates down to a negative territory. In other words, the central bank prints the money, buys bonds, bond prices rise, which means in the inverse world of bond pricing, the higher the price, the lower the yield is to the buyer. The return from the bond is the same irrespective of what price is paid in the secondary market. So as the price goes up in the secondary market, the yield to that buyer diminishes. We now have a situation where $15 trillion of sovereign debt in the world, 15 trillion, that's a very large number, 15 trillion of market traded debt, of sovereign debt, is at a price high enough so that the yield to the owner is negative. That is to say, the price, they bid the price up to the point where they're paying more for the bond than what they ever get back in interest and principal in total. So that's a huge amount of buying power at a negative rate. Okay, now so you put that world aside and the United States on the other side, and the United States still had let's go back 6 months anyway, where our long-term treasury rates in the U.S. were low. We had gotten down to a 3% rate on 30 years and maybe a little bit lower on 20 years. And then suddenly our rates start to fall. And they start, as a matter of fact, over the past year, calendar year, the treasury rates have fallen in half, below the lowest rate we've ever had before. In fact, in the United States today, we have the lowest interest rates in the 229-year history of the United States. So how did this happen? Well, if you read the newspaper, it has to do with our central bank, the Fed. It does not have to do with our Fed. As a matter of fact, they had about a 4-year period of tightening after they got through with, quote, the Great Recession saving of quantitative ease. They tightened rates for about 4 years. So, but basically, how are we getting such low interest rates? Well, it turns out that the countries that are most distressed are running their printing press, buying their country sovereign bonds, raising the price, lowering the yield, so that a very large differential has accumulated in the interest available in foreign sovereign securities versus U.S. securities. If the long-term treasury rate here is 30, And in Japan or Europe, most of them are at -0.5. The spread is 3.5. So basically, now we start having a new dynamic develop, which is private investors who are investing money at an institutional level or even at a personal level for retirement or for an endowment fund. They need income. Well, you can't pay off retirement obligations when the interest rate you are earning is negative. As a matter of fact, most of those pension funds require a target yield of 6 to 7% in order to fulfill their contracts long term. So basically, after about a half dozen years of this, an awful lot of private entities for example, pension funds and insurance companies, endowments, and others have shifted their funds, and this all depends on capital outflow restrictions. Could they move it out of their country and their currency to the United States where the rates were 3.5% higher?